So here I have two black t-shirts. They're both the same shirt, except one I paid $20 for and the other only $15. Assuming the only difference between these two shirts is the price, it'd be silly not to just pay for the one that's $5 less, right? I mean, why pay more when you can just pay less? The same logic applies to investing in dividend stocks, and while identifying cheap dividend stocks is a little bit more complicated than comparing t-shirts, there are a few simple metrics we can look at that make the process much more straightforward, all of which we'll be talking about in this video. So without further ado, let's get into it. All right, my friends, what is going on? It's so great to see you guys. My name is Ryan Williams, and here I show you how to get started on the road to financial freedom by investing in dividend stocks, which is something that I've been doing now for the last 2 years. And truthfully, guys, if I can do this stuff, then you most certainly can as well. I promise you that. In my opinion, building a dividend stock portfolio is the easiest way to create passive income. And over the last 2 years, I've grown my portfolio from about $100 in annual dividend income to now nearly $1,600, which equates to about $130 coming in every single month without having to lift a finger. All I do is just buy more stocks, reinvest the dividend income, and repeat this process every single week to create what's basically an infinite loop of ever-growing passive income. And just this week, guys, I swooped up some more shares of a few pretty awesome companies like Intel, which, as you guys can see, I invested $50 into Intel and bought just over 1 share. I also invested $50 into Starbucks, which has been one of my favorite stocks to buy lately. You guys know that if you've been watching my videos. And with the $50 I invested in Starbucks, I got just over half a share. And then last but not least, I invested another $50 into Snap-on, which is the newest position in my portfolio. I started buying the stock a few months ago now. And with the $50, I got about a quarter of a share of Snap-on, which brings my total contributions for the week to $150, which is essentially my method to the madness. For those of you who don't know, I invest $150 into my portfolio every single week, rain or shine, whether the market is up or down. Anyway, guys, moving on, getting into the main point of the video, which is different ways to identify cheap dividend stocks. The first and probably the most obvious way is to just look at the share price performance. If a stock is going up in price, it's obviously getting more expensive. And if a stock is coming down in share price, it's definitely getting cheaper. It's common sense, right? And here on seekingalpha.com, which is the website we're looking at, this is what I use to do my stock research and look for different dividend stocks. They have a really nifty tool called a stock screener, which can be found right here, that will allow us to input some criteria. In this case, we'll look at stocks based on their share price performance, and it'll compile a list of all the stocks that have come down in share price or that are coming down in share price. And so we're going to set up a screen right now and see which dividend stocks it spits out for us. So we're going to create a new screen. And now, guys, what I'm going to do is I'm going to go over into the advanced filters right now and set it up so it only gives us stocks that are coming down in share price. And I'm just going to skip ahead because it might take me a minute to do so. All right, guys, so the criteria I've used, just so you know, is basically stocks here in the United States that pay a dividend and also have a minimum of 10 years of growth. And also, as far as share price performance, ones that are down at least 7% year to date. So from January 1st until today, each of the stocks on this list, which there are 130, have come down in share price at least by 7%. So we know they're at somewhat of a discount. So we're going to hit done, and it's going to show us all these stocks. And as you guys can see, there are some recognizable names on here. We have AVGO, Broadcom, we have Federal Realty Investment Trust, which is a dividend king. Scrolling down, we have Microsoft, we have UPS, we have Lowe's. We're actually going to take a look at this one. And as you guys can see, Lowe's looks to be an example of a stock that is getting cheaper by the day. Year to date, from January 1st till today, it is down nearly 20%. And coincidentally, Lowe's is a stock that is currently sitting on my watch list, and it's one that I've been really considering adding to my portfolio lately because it is really coming down in share price. And just so you guys know, when I'm doing my own stock research, this is the very first thing I look at. I try and identify stocks that are going down in share price as opposed to going up in share price because I want to get it as cheap as I can. And if a stock is getting more affordable by the day, then that's good news for me as a dividend stock investor. And if a stock's share price performance indicates that it is heading into buying range, I will dive a little bit deeper and take a look at the second metric that I wanted to talk about today, which is the PE ratio. But before we get into that and cover the PE PE ratio, I want to first invite you guys to the Dividenders Discord group. It's free to join, and essentially this is just one big group chat filled with almost 500 other dividend investors. And here we talk dividend stocks all the time, guys. Everyone is sharing their portfolios, sharing their analyses on tons of dividend stocks and their valuations, and also we're in there just offering support and motivation to one another on this journey to financial freedom, which I think is one of the biggest benefits to being in the group. At any rate, I would love to have you guys join the community, and to gain access to the Discord group, all you need to do is click the link in the description of this video. It will take you right there. And if you do join, be sure to say what's up, because we will all be stoked to see you in there, and we'll look forward to giving you a warm welcome. So click the link in the description. Anyway, guys, getting back to the PE ratio, this stands for the price to earnings ratio, and it's also referred to as the price multiple or the earnings multiple. And what this does is it gives us a relative value for the stock that we're looking at, and we can use this PE ratio to compare stock A to stock B, for example. You know, we could compare Lowe's to Home Depot and see which one's at a better value based on the PE ratio. And to find this number out, I mean, obviously it's right here on the screen, but the calculation to do so is very simple. You just take a stock's current share price, which in the case of Lowe's is about $206, and divide it by the earnings per share right here. And if you do so, you would get a PE ratio of about 15. And there's two different ways that we can look at a PE ratio. And to explain that a little bit further, we'll go over to the valuation page, guys. So number one, we can use the PE ratio and compare it to other stocks within the same sector, which is what's going on right here. So in Lowe's case, it's in the consumer discretionary sector, and its PE ratio of 15 is about 21%, almost 22% higher than the sector median. So that's one way we can look at this. Number two, we can also use the PE ratio and compare it to the stock's historical record. So in the case of Lowe's, its forward PE ratio of 15 is nearly 20% lower than it has been on a 5-year average, which the 5-year average PE ratio for this stock is 18.46. So it does look to be at more of a discount than where the stock is usually at. And just to give you guys a rule of thumb, when looking at a company like Lowe's, a PE ratio under about 20 is what we're looking for. Anything under 20 could indicate that it's at a fair value or an affordable valuation. Anything above 20 gets a little bit questionable, but this is not set in stone, guys. It really depends on the stock and the level of growth we can expect from the company moving forward. One example of this being the case is actually Starbucks, which I know I mentioned earlier has been one of my favorite stocks to buy lately, who has a forward PE ratio of 25, definitely above that 20, right? And also very high above the sector median by over 100%. So not as good of a discount compared to other stocks within the sector, but it is nearly 30% cheaper than it has been historically, which is great. And this is where your own judgment and discretion comes into play. You can look at this and say two different things. Number one, because the PE ratio is above 20, Starbucks is immediately overvalued. Or number two, okay, it's above 20, but we're expecting a lot more growth from this company in the future, and it's also 30% lower than its 5-year average PE ratio. So there's kind of two ways to look at it, and every investor is going to come to a different conclusion. All right, guys, now at this point, we have covered two pretty simple, straightforward metrics to try and identify cheap dividend stocks. The share price performance, which it goes down, it's headed towards buying range, that's good. And number two, the PE ratio, we like to see it under 20 in a lot of cases. And now moving on to number three. This one is maybe a little bit more complex and could be more nuanced than these first two. And the third metric that I want to talk about is a discounted cash flow calculation, which may be something you've heard of before, maybe not. In case you haven't, this calculation helps us determine a stock's fair value based on its expected cash flow returns in the future. In other words, it helps us establish a company's value today based on how much money we anticipate it will make in the years to come. And today, guys, we're actually going to run through one of these calculations, and we'll use this spreadsheet right here that was made by my good friend Jacob Morris, who has a banging channel here on YouTube. He's putting out some really great info, and he did a really good job putting this spreadsheet together. It's very easy to use, even for beginners, and if you guys want to grab this for yourselves, the link to do so is in the description. And to learn how to use it, he's even got a link to his video where he walks you through it right here, so definitely check that out. But anyway, guys, to do this calculation, we'll need a few pieces of information. And on this spreadsheet, we're really only inputting data where these cells are highlighted in yellow, right? So we need to start with the stock. And in today's example, we're going to use Lowe's. And to save us time, I've already put in all of the necessary information, but I do want to walk you through it just so you get a brief overview, guys. Some other information you would need to input is the company's current cash on hand and the total debt, both of which are numbers that can be found on a company's balance sheet. So if you go over to Seeking Alpha, go to the financials right here, it'll give you all of a company's financial statements, the income statement, statement, the balance sheet, and the statement of cash flows right here. So all the information required to do this calculation can be found there. And scrolling down, we'll also need some other pieces of information like the cash from operations, the capital expenditures, the net income, which can also be found on the financial statements, as well as the company's total revenue for the last few years. Once you've put in all these numbers, it will give you a fair value of the stock today, which in the case of Lowe's, it gives us a fair value of $200.39, which according to this spreadsheet is 3% lower than the company's share price. So the fair value is about $200, but if we go back over here, guys, remember Lowe's current share price is $206. So it is just outside of buying range, which is fine. It doesn't mean you shouldn't buy it today. None of these metrics really is the end all be all, guys. Ideally, what you'll want to do is take a look at all of these and compare and contrast. And by having all this information at hand, it should help you make a better, more informed decision as to whether or not to buy the stock, and if so, at what price you should buy in at. I personally look at all three of these metrics when investigating a new stock, usually in this order from share price to PE to discounted cash flow, and may or may not dive deeper into the stock based on my interpretation of these metrics. And hopefully everything we've talked about today has been helpful for those of you who are starting to learn how to research stocks and really get into the weeds with the companies you're looking at. And if you're interested in learning more about dividend stocks with me, then let's keep the party going, guys. Click the link right up over here and check out this video. And if you want to see more videos from me in the future, then hit that subscribe button right over here. I'd love to have you follow me along on the journey. So thank you guys so much for watching. I really appreciate it. I hope you all have a great day, and I will see you in the next one.